Alrighty, let's go ahead and get started. Again, if anyone does have any questions, please do type those into the chat box. As all audio has been muted, I'm happy to address any questions that you might have. But today we're going to be covering some year-end strategies for small business plans and those small business owners. The good news is that with some tax law updates, it's a lot less stressful for year-end for retirement plans than it has been in years past for you. So some good news there, but we'll definitely cover contribution limits, things to consider going into next year and the like. So again, do really appreciate everyone being in here. If you want a copy of the slides, they are attached, and type in those questions as they come up. I'm your presenter today. My name is Alex Perny. I've been with Advanta since 2012. If you'd like to contact me afterwards, all of my contact information is right there on the screen for you. Love to help you out with any specific questions that you might have. I really enjoy doing this kind of work for my clients, especially the small business owners. There's a lot to unpack with small business plans, and choosing the right one can really make a marked difference in the amount of money you can contribute, the amount of tax deductions that you can take, and also different options when it comes to Roth retirement plans as well. They certainly do have their place, depending on what your structures and strategies are. Maybe getting tax deductions is good for you, maybe it's bad for you, but we'll certainly dive into that here today. A little disclaimer, since we are going to be covering some stuff that definitely gets into areas where people are going to need tax advice. Advanta IRA and our employees do not provide investment advice, nor do we endorse or promote any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. And I would add on to that, and also before specifically choosing the type of retirement plan you'd like to use, because between the three of them that we're going to cover in depth today, there are a lot of different avenues that you can take and different benefits that you might be able to glean from that. So a few takeaway points: choosing the correct plan for your specific goals. That is kind of the big one, is to get you with an idea of which one might work best for you. The differences between the three available plans and the tax benefits that each of these specific plans can offer you. Now, they all definitely have some cross-pollination between them as far as what benefits they offer, but the amounts of money you can add in depending on the amount of revenues you generate from certain areas in your business is definitely going to drive the decision-making process for you. So there's, again, kind of a lot to take in from the presentation today, but what I'd like people to really understand are these three high-level points for you to be able to kind of go forward and maybe talk to your tax advisor or your CPA and figuring out, hey, if you don't have a plan in place after this year, which one might make the most sense? Which one's going to help you out the most? Which one is going to be most beneficial to you? Now, the good thing is specifically to this presentation, I'd like to leave this slide in here, is that specifically with real estate professionals, these types of plans can offer you a lot of benefit to different types of investments, whether you're looking to capitalize on your own expertise, utilize these types of plans for getting in more business as far as more money and deal flow that can come into you. It's really kind of an interesting way to look at it when you think, hey, if I'm a real estate professional, which a lot of our clients are, I can use this to help defer a lot of my taxation. I can also use this to really kind of help, again, bring in more capital to what I'm doing. So again, just a little bit that I'd like to leave in there. This is a slide from another presentation, but again, it definitely is kind of something to keep in mind. So a little bit about Advanta IRA. We've been in business for over 20 years. We have been, kind of seeing a lot of different things that clients have done, seeing a lot of these markets mature and have different life cycles with which what is gained and waned in popularity for all different types of retirement plans. So if you're looking for something, I can definitely kind of go back, at least in my professional experience, and say, hey, look, this, this is what some people might have been doing then. Here's some of the benefits they might have been looking to glean from that at that point. But again, there's a lot of things that go into this, and experience definitely helps when trying to discern which one of these is going to be the most beneficial. Again, a little bit more about Advanta. We administer over $3 billion worth of assets for our clients, something we're very proud of, something that we have strived very hard to continue to bring these types of plans and this type of investing focus to the masses, and it certainly is definitely seemed to have gone that way. And if you're looking to do this, Advanta IRA, we offer all of our clients direct personal account management. So it doesn't matter if you have a $10,000 retirement plan or a $10 million retirement plan. We aim to give every single one of our clients the same type of local and specific expertise that you really need in order to be able to do this stuff yourself with a guiding hand from us. If you would like to learn more, we do host bi-weekly events. I host our podcast every week. We also maintain an up-to-date blog, all great resources if you'd like to, again, learn a little bit more. And a reminder that the slides here are attached for you as well. Self-directed retirement plans simply just kind of refer to the fact that you can take control and utilize these plans for investing in a multitude of different types of assets, not just stocks, bonds, and mutual funds, although we do now offer that to our clients to be able to do brokerage at Advanta IRA as well. But alternative assets include real estate, mortgage notes, private placements, really anything that's not a traded stock, bond, or mutual fund is the kind of options that these plans will allow you to engage in while doing self-direction. And a lot of people just simply haven't heard about that. And it's not necessarily that these types of plans are just now coming into existence, or this is just a new way that the government is just now allowing people to do this. It's just a smaller part of the actual marketplace. And even with a marketplace being small, when you're talking about a $37 trillion retirement plan ecosystem, even the small parts of it are very sizable for the amount of capital that can be saved and also utilized and tapped into. Kind of going back to the slide I mentioned about real estate professionals or anyone that might be looking to raise capital, retirement plans are a fantastic fantastic option to look at when it comes to doing that. Why do some people choose to do this? Well, again, a new source of capital. I maybe have stock market fatigue. Granted, the stock market is doing very well right now, but when everything goes up, it also commensurately will come down eventually. But the big one that we're going to focus today on is tax benefits. So the benefits of being able to defer a significantly higher amount of money than just the $7,000 or $8,000 that you're looking at from a traditional or Roth IRA perspective is probably the biggest thing that I'd like people to take away from this, is that you have so much more money you can put into these business plans that will either, one, give you an incredible tax benefit, or two, give you a future tax benefit in the form of doing these things in an after-tax or Roth fashion. So some of the key reasons why people look to do this are listed here, but the big one for business owners, especially when it comes to looking at, hey, here's how much I made this year, here's how much I might be looking at in taxes to pay next year, these plans offer a great avenue for helping to mitigate that. A few more of the assets before we get into the meat of this. It doesn't necessarily have to just be single family homes or other different types of well-established assets. We have plenty of clients that go forward and invest in all sorts of interesting avenues when it comes to specifically the self-directed realm. It's not just a single family rental. It can be mobile homes. It can be easements. It can be mortgage loans, tax liens, tax deeds, all sorts of great different types of alternative assets and other alternatives as well. So if you're in a business where you are adjacent to a lot of different types of alternative investing, there's typically a path forward for utilizing these plans to do that. Remember, it's not just the stock market you have to focus on with self-direction. There are so many more options. And again, we do webinars, pretty much specifically on each one of these things listed up here. But I like to leave it in here just as kind of a primer to understand that, yes, the tax benefits are great, but just putting money away is only a part of the equation. You don't just want to be fighting inflation. You want to be able to invest these and create a return for yourself and enjoy not only the contribution tax benefit, but the benefit of the tax deferred or tax-free growth as well. And there are a million different options out there for you when it comes to this. Now, what types of plans are out there? So individual plans are going to be your traditional IRA, your Roth IRA, inherited IRAs as well. And remember, those aren't really something we're going to focus on today, but those are what most people are inherently familiar with. They are aimed at the individual taxpayer. They don't allow for different amounts of income to be contributed if it's coming from another business. You basically just get $7 or $8 grand, depending on your age, over or under 50 and a half, to contribute into one of those plans per year. Now, that's all well and good. I'm assuming none of us would walk by $8,000 lying on the sidewalk and not pick it up. It's definitely a benefit we should all be using. But in the context of mitigating tax bills for individuals that are earning money in a business, a $7,000 deduction doesn't really do a whole lot, nor does it really get you very close to the threshold of being able to invest in a lot of alternative assets. the beauty of business plans such as solo 401ks, SEP IRAs, and simple IRAs is that it does get you there much faster. It offers you much larger tax benefits. It offers you much greater contribution limits, and it gets you to where you're looking to go significantly faster than a traditional or Roth IRA would just on an annual basis. Again, not saying that traditional Roth IRAs don't have a place. They are awesome account types. I think we all should be taking a look at those specifically if you have old 401ks, maybe you're not a self-employed individual, but again, they are definitely something to be aware of. But what we're going to be focusing here is going to be on the right-hand side of the screen, the solo 401k, the SEP IRA, and the simple IRA. And while they all do offer markedly different experiences, my personal preference really is for the solo 401k. As far as the degrees of flexibility, the amount of money you can add in, and the kind of dollar for dollar comparative analysis between those and the other ones, you can put more money in for the same amount of money earned, which I think is something that is, an often overlooked benefit of that specific plan type. Now, 401ks are not perfect. They don't scale very cost effectively. So if you have employees, and we'll get into that in a second, they also are more complex to administer. So definitely some things to consider. Other account types for self-direction, just to make sure we're rounding this out. The HSA and the ESA, again, great things to look at if you have high deductible healthcare coverage, or if you have children that are looking to go potentially and have higher education expenses. ESAs are another great avenue for that as well. Before we, again, I promise this is kind of the last slide before we get into the meat of what we're doing, but I would be remiss if I didn't kind of mention year-end stuff, since it is now end of December, which is hard to believe that we're already in the 5th day of the last month of the year. But Roth conversions, all of the plans that we're going to talk about, so the SEP IRA, the solo 401k, simple IRAs, all allow for Roth conversions, meaning that if you have contributed into these plans pre-tax, you have the ability to convert or move the pre-tax dollars into a post-tax account. This is really the one kind of last bastion of year-end hard cut 12/31 at midnight turns into a pumpkin, right? If you want to do a Roth conversion and utilize this year's tax allowance, so if you have some room in a tax bracket, or maybe you're expecting to earn a lot more money next year and a Roth conversion makes more sense for you this year, we have to do that by year's end. So if you're looking to do that, definitely a time to reach out. Again, solo 401ks, SEP IRAs, simple IRAs can all be converted to Roth after-tax accounts. But if you're looking to do that, now is the time to have started doing that. It's not too late. We can definitely still get it done. But I like to really hammer that home, especially with these end of year presentations, that if you're looking to go from pre-tax to post-tax, you really need to kind of, give us a call and get that ball rolling now. Okay, we got a question. We'll take care of this, then we'll get into, again, the different types of business plans. Okay, let's see. I want to open a self-directed account, but was told that if I have a non-employer managed or sponsored IRA, I won't be able to, or it's not as easy to do a regular backdoor Roth annually. No, I would need to take a little bit closer of a look, and that's kind of an off-air conversation to have, but at a high level of what you've mentioned there, with wanting to have a self-directed account, but if, again, nothing there would lead me to believe that anything you're looking to do is more difficult than just a little bit of paperwork, and just kind of pulling the trigger on it. I see someone had raised their hand. If you do have questions, please type those into the chat boxes. I just don't monitor the raised hand section. So just type the questions in and we'll address those as they come up. But thank you for the questions. Keep them coming. So employer plans, what are they? So again, we have 3 basic plans to choose from, or I should say but there are 3 basic plans to choose from. You have the SEP IRA, the simple IRA, and the solo 401k. Who are these plans for? Sole proprietors, independent contractors, self-employed individuals, small partnerships such as LLCs with a few equitable owners, corporations, they can be a C Corp or sub-S corporations. Now, excuse me, these plans, again, you can utilize these plans for all of these, and there are certain considerations to give for employees. But again, if you fall into any one of these categories, you don't necessarily have to be like, oh, I'm only a sub-S, I can only do this, or hey, I'm an LLC taxed as a partnership, or maybe I'm an LLC taxed as a sub-S. Any of these different plans can work for these types of business structures. So you're not necessarily precluding yourself from choosing one over the other just by your corporate structure and your tax election. But the contributions being made into the plan are going to be significantly different when it comes to calculating them depending on how you file your taxes. So that is a consideration to give. And one of the reasons why I do mention that people should absolutely be contacting their tax advisors, after you've listened to this presentation and kind of gotten an idea of what you'd like to do, because maybe there might be a benefit, maybe filing as a partnership is great, but when you want to start really kind of trying to turbocharge and pump money into a retirement plan, changing your tax selection to something different might be beneficial. Again, may or may not, your mileage may vary, but it's an important question and things to look at, with regard to your corporate structure and integrating a retirement plan in there if you don't already have one. So SEP and simple IRAs offer tax-deferred growth. Now, as of this year, well, I should say 2 years ago, the Secure Act 2.0 brought about Roth, SEP, and Roth simple accounts. Excuse me. However, up until maybe a few months ago, the IRS had given no reporting codes to us to be able to allow us to offer those plans. But now we are able to. So SEP and simple IRAs are now able to accept after-tax contributions. So your deferrals into that can now be made after tax, which is awesome. Before it was simply just the solo 401k that allowed for the after-tax option, but now, again, as of just this last quarter, we've been able to do that. So if you want after-tax growth, it's not just the solo 401k that can offer it. The SEP and the simple can also as well. These plans offer larger contribution limits and are typically going to be less costly than a managed 401k. Now, solo 401ks offer the largest potential contribution for a business without employees, but there is things like discrimination testing and plan auditing that goes with having a solo 401ks when you have common law employees that aren't necessarily in place with SEP and simple IRAs. So the self-employed individual, the owner-operated business, the spousal partnership are really where solo 401ks are going to offer a very big benefit. But once you start scaling and having common law employees, that's when you're going to start getting into significantly higher plan administration costs than with just the SEP or the simple. Okay, question was posed. Said, what is an ESA? Is that the same as an FSA? No, they are different. An education savings account, or more specifically, a Coverdell education savings account, they typically get called CISAs, are different than a FSA. FSAs can mean a few different things depending on the acronym you're referring to. FSAs do have a basis for certain types of education savings accounts, but they also are more commonly referred to in the context of health savings accounts and FSAs are not the same as HSAs. I know that's a lot to take in, a lot of acronyms, but specific to your question there, an ESA is not the same as an FSA. So it's important to understand who you can exclude with these types of plans. And I know that sounds harsh, but it's important to understand when you might need to switch between a different plan or when you need to offer these plans to people. Because just because someone works for you potentially doesn't necessarily mean they want to participate in a retirement plan. I wish when I was 18 and younger that I was more cognizant of the fact of how important retirement plan savings were. But again, I would have probably been just like, hey, give me my paycheck and I'll go on my merry way. And again, most people that are that young, aren't too concerned with it. So you can exclude individuals under the age of 21 from SEP simples and solo 401ks. You can also exclude non-resident aliens or union employees that are covered by collective bargaining agreements. So those are the three kind of individuals, if you do have people working for you, that can automatically be excluded. Now, what types of employees must be included? So for solo 401ks, it has to be a common law employee, and that definition changed a few years ago under the Secure Act 2.0 that came out in the beginning of 2023, legislated in 2022. So it changed from just being 1,000 hours a year as the litmus test to 1,000 hours a year or an individual that had worked at least 500 hours a year for 3 consecutive years. So if you have a common law employee as defined under the Department of Labor definition currently, remember, they have to be offered the ability to participate in a solo 401k. With a SEP IRA, you get a little bit of a different example. So you can exclude individuals who have worked at least or you have to include individuals who have worked at least 3 of the last 5 years. So even if you maybe had a common law employee, you don't necessarily have to include them if they don't meet that litmus for the simple or the SEP. And then the simple, you have to include those individuals who have received at least $5,000 in comp during the last 2 years. Okay, some SEP and simple advantages. They do have their advantages, and you'll really kind of see why I maybe have a little bit of a crush maybe on the solo 401k here when we talk about contribution limits. But everyone, especially small business owners, are always going to be concerned with cost, and rightfully so. Every penny counts, and pennies make dimes, dimes make dollars, and so forth and so on. So SEP and simple IRAs are going to be just on less expensive to administer. Contributions are made to IRAs. You have no fiduciary liability like you do with a solo 401k. The individuals can choose the IRA custodian. So let's say if you offer a SEP or a simple IRA and you do have employees, then they don't necessarily have to self-direct. So you do have that additional ability to offer these types of plans and not say, hey, look, you have to self-direct. If maybe they just want to invest in stocks, bonds, and mutual funds, if you do have employees, then they can really self-direct wherever they want to if you wanted to offer some type of retirement plan benefit. There are flexible contribution and distribution features for these plans, meaning that the contributions can be scaled very easily, and there's no kind of bifurcation. So with the SEP IRA, it's just basically based on comp. You set a certain amount of deferral for the comp for everyone, and that's what you defer into the plan. Simple IRAs, you have 2 options. It's either an elective contribution of compensation or a non-elective contribution to the plan. So it's a little bit simpler when it comes to factoring in what you are going to actually be contributing in and how you're going to be doing it with these plans. And employers only have to contribute to those employees with more than 2 years of service for a simple or 3 years of service for a SEP. Apologize for getting a little confused there. I was looking at a different note on this slide deck and got a little mixed up. Solo 401k advantages. So you have all of the benefits of traditional business retirement plans plus significantly higher funding limits. Slide or 2 here, we'll actually get into what the actual contribution limits are, and they are sizable. And it allows for you to defer different buckets of income. And again, depending on how you're actually filing your taxes, might, again, benefit you more one way or the other. So you have a business contribution. You also have a personal contribution that goes into a solo 401k, and it's not necessarily based so much on a percentage basis as it is just on a net number basis of just how much you can contribute to the plan. There are great rollover opportunities, and unlike SEP and simple IRAs and any other type of individual retirement plan, 401ks allow for access to tax-free loans. You can borrow money personally against your 401k to use for whatever you need personally. That can be a new roof on your house, that could be a vacation, that could be for a trip to the casino, to put it all on black. Again, you can take a personal loan out of a 401k. Now, I wouldn't recommend doing the last one, but I like to illustrate the variety of things you can do with them, is that you can take a loan against that plan and you have up to 4 years to repay it back to the plan. You're under no obligation necessarily to put it back in within 60 days. Unlike with SEP and simple and traditional and Roth plans, you have only 60 days to put money distributed out of that plan back in. So the participant loan, great option for these, definitely offers people a lot of flexibility, and especially if you're self-employed, maybe you have a tight month or quarter and you need some access to capital personally to buy some groceries or put gas in your car or buy materials for your business. You can use that plan a little bit more flexibly than you can with a SEP or a simple. And again, depending on how you operate your business, that may be a great benefit or maybe something you never even need to look at. But again, it is there and it is baked directly into the structure of the plan. And for self-employed individuals, it is a very cost-effective administration. Once you start getting into having common law employees or people that need to be covered by it, that's when things start getting a lot more expensive. But again, we're here to focus on the self-employed individuals, so that's where we're going to be focusing on. And lastly, Roth 401ks. they're awesome. You know, paying no taxes is better than paying any taxes. I think a lot of people would agree with. But again, you have to be okay with paying taxes in the present term. But solo 401ks have offered the Roth option for, well, let's see, since 2005 is when that came into existence. So Roth 401ks have a very well-established administration structure and a lot of different options that inherently are baked into having been around for so long. All right, we got a question. Let's take a look. Okay, so I am the single member of an LLC and I do not have any employees. My LLC is my side business, which has $8,000 a year in revenue. I do have some savings. Can I make a contribution more than $8,000 from my own savings to maximize the contribution? Which plan is better? Well, I hate to kind of have to say you need to talk to a tax advisor, but the potential to contribute in more than that is potentially available. Now, if you only have $8,000 in net income for that business, typically you're just going to say, hey, I can maximize my elective deferral, which we'll get into in the next slide. You do have the ability to potentially make up after-tax contributions to these plans, depending on how you have it structured and what elections you make. But again, there is the potential for that, depending on, you know, if that revenue is indeed derivative of the business activity, there is the potential to add in more than that, but it's only going to be on one side of the equation, and we'll get into that in a second. It's going to be on the non-elective side of the 401k, but you're going to be capped at the amount of elective deferral you can make, and it's going to be a little bit less than that because you have to do the contribution on the elective deferral side and take into account 1/2 less self-employment tax. So depending on what that $8,000 is that gross, is that net, has the self-employment tax already been netted out? It's going to be a little bit more analytical than that. But again, great question. If you want to get more into the weeds with that, I am happy to schedule a consultation. Or again, I would also recommend kind of floating that past a tax advisor to figure out, you know, hey, which one's best? Would a SEP IRA be simpler? Just say, hey, I'm going to take 25% and put that in there. Again, I don't know. That's, again, a little bit more of a personal question to kind of address. So here's the fun part. We talk about money. How much money can you put in these plans? Well, for a traditional Roth IRA this year, you can drop in 7 or 8 grand. Again, fairly straightforward. If you have earned income, at least over that, you can put that into a traditional or Roth IRA, not a problem. You get an additional $1,000 kicker if you're over 50. SEP IRAs, 25% of comp. Now, this is where kind of a good illustration to do a comparative analysis between the 401k and the SEP IRA really is apparent. So you can contribute up to 69 grand total, but you have to make a lot of money for that to really be a viable option. So if you had $100,000, and we'll show this on the next slide, which is really cool to see how these things break out. You can, if you had $100,000 of earnings for the business, you can contribute 25 grand. Right, simple, easy. You can also contribute your $7,000 or $8,000 to that plan as well, because a SEP IRA really is kind of a top hat that sits on top of a traditional IRA. It's called a SEP component. So 25% of your $100,000, 25 grand, and then you can also plug in $7,000 or $8,000, so you get up to, excuse me, $32,000 or $33,000 of total plan contribution limits for a SEP IRA, excuse me, depending on how much you make. But again, it is a percentage basis, and it always is going to be made on it's going to be made on behalf of the business. So depending on, again, how you have your business structured, whether you're passing through tax benefits on something like a Sub S or you're filing as a partnership, this may or may not be something that is incredibly beneficial to you. You want to see where these deductions are going to hit, you know, where is this ball going to drop when it comes to who is claiming that deduction, and also how you can maximize the deduction maximize the contribution for the amount of money earned. So again, SEP IRAs, easy enough to factor. You take your total comp at the end of the year, multiply by 0.25, and that gives you your plan contribution limit, so long as it doesn't exceed 69 grand. Simple IRAs. you have $16,000 of comp you can add in, plus an additional $3,500 if you're over the age of 50. And then here's where we kind of hybridize it between the SEP IRA and the solo 401k, is that the business has an additional amount they can add in. It can either be up to 3% as an employer match or 2% of the employee's compensation. So here you really kind of get to see the bifurcation between where deductions are taken. So the 16,000 or the 19,500 is going to just be an elective deferral of comp. So you, the employee, the individual taxpayer, claim that all as a salary reduction on your tax filing. Now, if the business again passes through everything to you personally, then you also might get to capture in that additional contribution of the 3% employer match non-elective or the 2% comp contribution going in there as well. So again, there's two different parts to it. You have what you're electing to defer out of your comp, and then you have what the business is matching in. Now, for those individuals that maybe are just high wage earners and paid out everything on 1099, a SEP IRA is great because it just helps you reduce that number a lot quicker. Maybe for those individuals that are sub S or that have like a partnership or something, maybe the simple IRA does make a little bit more sense. But granted, there is still a little bit more of a constraint on how much money you can get into that plan. Now we come to the solo 401k. Again, dollar for dollar is going to be the most powerful for the same amount of money earned. So 23,000 is what you can contribute just out of your comp per year to that plan. So you make 100 grand, great, you can drop in 23,000. You make 35 grand, you can contribute 23,000. It's not a sliding scale, or it's not a percentage basis like the SEP IRA is. So with the SEP IRA and the solo 401k, just based on the elective deferral comparison, it is almost the same. It's a $2,000 difference between the two of them. And you could only have shown, let's say, $30,000 of income to make the $23,000 contribution, as opposed to having to show $100,000 of earned of compensation for the SEP IRA to even be at an even keel. You also get a $7,500 kicker if you're over the age of 50 in a solo 401k of just elective comp deferral. So if you're over the age of 50, you can contribute up to $30,500 just of elective contribution into the plan. And remember, that's not a sliding scale. That's just comp earned, comp contributed. Theoretically, it could be 100% compensation contribution to that, but you do have the factors of taking your self-employment tax net for that. So just a few things to consider with that. But again, very powerful. Where the solo 401k really shines is the fact that the other part of it, kind of like the simple IRA, you can contribute up to 25% of your net operating income to the plan per participant. So if you had just you, sole business owner, you had $100,000 of net operating income, you could contribute an additional 25 grand to the plan as well. And again, the total contribution to a solo 401k can't exceed $69,000 or $7,600, depending on your age. So the other cool part about solo 401ks is it allows for after-tax catch-ups as well, called the mega backdoor Roth. I'm not a big fan of the nomenclature for that, but it does allow for you to kind of make up the difference between the total plan contribution limit and what the business match allowance would be. Because remember, it has to be 25% of NOI, but you are allowed to, after tax personal dollars, make up that difference. So you can basically always, depending on how much money you have, maximize your contribution to that plan. A feature that is not offered in the simple IRA, a feature that is not offered in the SEP IRA. So again, there is a precipitous increase in the amount of complexity that comes with a solo 401k. Again, when you're just talking about 25% of comp factoring your contribution, or you're talking about looking at basically 3 different buckets that have different calculations. But when you're talking about an order of magnitude of how much more money can go into these plans, I think it's well worth it. And once you understand it, it's not that bad. I know I might go a little bit fast on this, and granted, I've been doing it for so long, but again, I've seen clients get a pretty easy handle on it fairly quickly. Let's see, question. Can I make periodic contributions to my solo 401k throughout the year? Yeah, absolutely. So long as that you have at the end of the year not exceeded any type of plan contribution limit, you can defer compensation, you can defer earnings into the plan periodically throughout the year. That is just fine. Again, just remembering that you can't exceed a total plan contribution limit. And also, if you are going to be filing at a non-standard date, you need to make sure that once you file your taxes for that specific year, you no longer are making contribution allowances, you're no longer making contributions to allocate towards that year in which you filed the taxes. So a good example, right? You file your taxes for 2024, unless you filed timely in April for your business. Well, you couldn't make a previous year contribution after that. You would only then in turn be able to make 2025 contributions. So when you go to file your taxes, you need to make sure that you are filing only for the years in which the year in which you have not filed taxes for, and that you are still allowed to contribute to that. And it brings up another good point, is that unlike in previous years, any of these types of plans can now be established after year's end for making all of your contributions. Up until this year, you had to have a solo 401k established by year's end to make your elective deferral contribution for that year. So that $23,000 or $30,500 just compensation contribution, you had to have that plan established by 12/31. Now you can establish solo 401ks, SEP IRAs, up until your extended filing deadline in October, and still make a previous year contribution, but you can't have filed your taxes yet. Again, important thing to understand. But going back to the periodic contribution question, it's absolutely allowable. Now, simple IRAs have a little bit of a different one. You have to establish that plan by, it is September 15th in order to make a previous year contribution, even if you have an extended filing deadline past that. A little bit of follow-up to that. Context, I'm a 1099 healthcare worker and income does fluctuate through the year, but I want to optimize. Yeah, that's fine. If you get paid out periodically, 1099, contract work, medical, again, that's all fine. Doesn't change the answer to that one bit. Contribution comparison. This is the one I really like to look at because it really illustrates just how powerful these things are for the same amount of money. So John's a sole proprietor in 2024. He has 100 grand in salary compensation. So what does the contribution look like for each one of these? Simple IRA, $19,500. He can contribute $16,000 of his salary deferral plus a $3,500 employer match. Easy, right? SEP IRA, $100,000. $25,000 is what goes into that plan that year, right? So again, pretty easy to look at. 100,000, 25% of that, 25 grand. Now, keep in mind that you can think about it a little bit more broadly and say, hey, look, I can still make my annual contribution to the plan, right? So yes, if you had, you're under 50, in this case, I'm factoring all these on him being 50. You can make an additional 7,000, so you'd have $32,000 of total contribution to a SEP. Solo 401ks. John can contribute $23,000 of salary deferral, plus an additional $25,000 employer match. So he has 48 grand in the plan. Same amount of money, but almost double what the other plans offer for the exact same amount of money. And also keep in mind with the solo 401k, if he's over the age of 50, he gets an additional $7,500 of salary deferral catch-up, plus you can utilize the after-tax contribution allowance to bring that up to the total plan contribution limit of 69 grand, assuming you have capital commensurate to be able to make that contribution. So unlike the SEP IRA, unlike the simple IRA, which say basically, hey, you've made this much money, here's how much money you can contribute, doesn't matter, you can't make up to the total allowable limits, solo 401k does offer that. Again, is it more complex? Yes. Does it scale as cheaply as the SEP and the simple do if you have employees? Absolutely not. But an apples to apple comparison for self-employed individuals, wholly owned entities, spousal partnerships, these plans are awesome. And then the catch-up contributions, just to kind of elucidate that in case you're just listening, simple IRAs offer a $3,500 catch-up. So you get to add in another $3,500 of compensation contribution to the plan. SEP IRAs, there's no catch-up. Again, contextually, you could say that the $1,000 catch-up for your traditional IRA contribution could be considered that, but in reality, it's basically nil. And solo 401ks offer $7,500 of salary deferral catch-up. Again, looking at these from the standpoint of a self-employed individual, they're really awesome, very powerful. But again, it may not work necessarily for everyone. And I don't necessarily encourage people just to go out and look for ways to make sure that you can automatically qualify for a solo 401k. If your business is running great and, $25,000, would make a market difference in that, then go for it. But the nice thing is that you have time to kind of figure out what you want to do. Now, if you wanted to change your taxing election for a given year, you might need to get on the ball with that and talk to your tax advisor about how you want to actually, file this year. That election may need to be made by year's end, but that's something to talk with a tax advisor about. Now, keep in mind, contribution and earnings are two different things. So we talk about how much you can contribute to these plans. That is going to be completely separate from how much money you earn on something. So if you contribute money to one of these plans and you have a few investments that pay out great, that doesn't preclude you from making a contribution in the future. If they are separate, your contributions do not count against your earnings, do not count against the amount of contributions that you can make. Let's see, question, going back one slide. So this question, let's go back one slide to this one. So the question is, in the first case study, John's making 100 grand. With a solo 401k, could John also do a mega backdoor Roth contribution too? Well, again, I wish there was a little bit more kind of unified terminology with this. The mega backdoor Roth contribution, typically it's the mega backdoor is an after-tax contribution that is basically stated there so you can make up the total plan contribution allowance for that plan. Otherwise, notwithstanding not having enough revenue to do so. Yes, you can do that. Now, also the backdoor Roth can also refer to just making a traditional IRA contribution and converting it to a Roth because you make too much money to directly contribute to a Roth IRA. Again, he could certainly do that as well. But contextually, there's a lot of bleed over in those terms. So in either context, yes, he could do that. Let's see. Another question. I receive a monthly payment from oil and gas corporate bond paid through my Advanta account. Can I claim this as capital gains or just an IRA disbursement? Again, that's a question more for offline, but in general, if your IRA owns something and it receives interest or it receives payment or royalty for whatever it owns, that's not capital gains. That's just earnings to the IRA. Even if you were to have that distributed to you personally, so it comes to the IRA first from the investment and then distributed to you, that's just going to be taxed at ordinary income rates. You're just going to get a 1099 saying you took a distribution from a retirement plan. Assuming it's pre-tax, there wouldn't be any basis to claim it as capital gains because it's just revenue generated from an asset within a tax shelter. Okay, transferring funds between these things. We're getting kind of to the end of it. So if you have some questions, maybe start filing those in there so I can start getting those answered at the end of it because I kind of do have a hard cut at one. But transferring funds, again, we covered the contributions pretty well. But if you want to transfer between self-directed accounts, you absolutely can. If you have an IRA, excuse me, you can transfer those directly. You can do direct rollovers. So if you have an old employer's plan and you want to roll over those funds to your self-directed SEP IRA, simple IRA, or solo 401k, you can use that as a source of funding as well. None of these plans have to be started from scratch. You can definitely fund them with rollovers and transfers. Indirect rollovers, again, if you're taking a distribution, you do have the ability to roll those back in. And getting the account started is very easy as well. Just a few things to kind of cover on what you are and aren't allowed to invest in. You can't buy insurance or collectibles. You can't directly deal with anyone that's kind of in your immediate family. And unrelated debt finance and unrelated business income tax and certain investment structures could also be a factor to consider as well. Again, here's the people kind of enumerated for whom you can and can't directly buy and sell things to. I just like to make sure this is in there so people have a good understanding, when it comes to picking a plan is really what I wanted to focus on, but also investing the plan is something you need to be, kind of aware of as well. So, understanding everything on plan choice is great, but if your ultimate goal is to do something that's not allowed by the IRS, well, maybe a little bit of the drawing board needs to be gone back to. But again, this is just kind of the enumeration of whom you're not allowed to directly deal with in that. So again, I hope people I hope I hit on the points of the takeaways here. It's choosing the correct plan for your specific goals, right? Is your specific goal to create maximum tax deferment or maximum tax deduction? Is your goal to be able to create two different buckets of deduction? Because remember, if you're contributing on behalf of the business, that's a business deduction. Now, a SEP IRA is only going to allow for a business deduction. A solo 401k allows for a personal deduction for the amount of compensation you put in there, and then the matching contribution from the business is a business deduction. And depending on how you have your company set up, that could either be something that's wholly passed on to you, or it could be something that is only claimed by the business. And if the larger of the two is somewhere that's not as advantageous for you, is that the best route to go? Definitely things to consider. And that's one thing I like about this, is that each one of these different options between the SEP IRA, the simple IRA, the SEP, the simple, and the solo 401k offers something for everyone. It's not going to be just, say, one size fits all. There's something out there that's going to be the best fit for you, and we'd be happy to help you figure that out. Again, to kind of close on the big point, especially for the end of the year, you have a little bit of breathing room. So, enjoy the holidays. You don't necessarily have to fight to get this plan established by year's end, but if you're thinking about it, it's definitely a time to do something about it. It's something that I deal with a lot of clients in, around tax filing season, and they're, running around, they're kind of, hair on fire, if you will. If you're thinking about it and you have a plan in place, no time like the present. But again, it's nice that we don't necessarily have an arbitrary force out date at the end of the year anymore for any of these types of plans. And if you'd like to learn more, again, bi-weekly webinars, podcasts, blog, please do feel free to reach out to us. We are always happy to help. And if you'd like some more questions answered by myself, all my contact information is up here on the screen. I would also be happy to schedule a one-on-one consultation. If you'd like a copy of the slides, they are attached here as well. But again, I do appreciate everyone being on with us today. I hope everyone had a wonderful Thanksgiving and a wonderful holiday season coming up here as well. It's definitely kind of a sprint to the finish at the end of the year for a lot of people. But again, that's all I got for you today. Is this webinar good for continuing education? It's not a registered continuing education credit webinar, but if you have like a self-reporting one, a letter for your particular agency, I'd be happy to sign on it, and if they accept it, great. But it's not necessarily one that is this specific one is not a approved continuing education credit. All right, well, it looks like most people are dropping off. Again, if you do want a copy of the slides, they're attached as a handout. Please do feel free to reach out to me. I love helping business owners out with these kind of plans. They are varied and also immensely powerful. So feel free to reach out with any questions. Again, really appreciate everyone being on with us today. Have a great holiday season.